Here's a summary of Intel Corporation's Q4 2025 earnings call, suitable for reading aloud. Good afternoon, everyone. We're here today to discuss Intel's financial results for the fourth quarter of 2025 and provide an outlook for the upcoming quarters. Q4 2025 financial highlights. Intel reported revenue of $13.7 billion, which was at the high end of their guidance and marked the fifth consecutive quarter of exceeding expectations. This performance was achieved despite significant industry-wide supply constraints that limited their ability to capture all demand. Non-GAAP gross margin came in at 37.9%, exceeding guidance by approximately 140 basis points. This was driven by higher revenue and lower inventory reserves, partially offset by an increased mix of outsourced client products and the early ramp of their advanced Intel 18A process. Non-GAAP earnings per share, EPS, was 15 cents, well above the guidance of 8 cents. This was a result of strong revenue, improved gross margins, and disciplined spending. For the full year 2025, revenue was $52.9 billion, a slight year-over-year decrease primarily due to manufacturing and supply chain constraints. Full-year non-GAAP gross margin was 36.7%, and non-GAAP EPS was 42 cents. Operating expenses were reduced by 15% year-over-year. Management's forecasts and outlook. Looking ahead to Q1 2026, Intel is forecasting revenue in the range of $11.7 billion to $12.7 billion, with a midpoint of $12.2 billion. This reflects typical Q1 seasonality and more acute internal supply constraints, particularly for the Client Computing Group, as they prioritize supply for server markets. For the full year 2026, Intel expects supply to improve throughout the year, starting in the second quarter. They anticipate strong growth in the data center and AI DCAI segment and lean client CPU inventory with excitement for their new Series 3 products. However, they are monitoring increasing component pricing, especially for DRAM and NAND, which could impact revenue. Operating expenses are targeted at $16 billion for 2026. They expect to generate positive adjusted free cash flow for the full year. Key strategic updates and highlights. AI-driven opportunity. Both CEO Lip-Bu Tan and CFO David Zinsner emphasized the immense opportunity presented by the era of artificial intelligence. This is driving unprecedented demand across the entire compute landscape, from data centers to edge devices. Intel believes its broad IP portfolio and capabilities in silicon design, manufacturing, and packaging uniquely position them to capitalize on this trend. Client Computing Group, CCG. The launch of their Core Ultra Series 3, formerly Panther Lake, on the Intel 18A process was a significant highlight. This lineup, now powering over 200 notebook designs, is positioned as the most broadly adopted AI PC platform. They are confident in their client roadmap, which aims to fortify market share and profitability. Data center and AI DCI demand for traditional servers remains strong, and Intel is focused on ramping capacity to support this. They are also centralizing their data center and AI businesses under a single leader to ensure tight coordination across CPUs, GPUs, and platform strategy. They highlighted the crucial role CPUs will continue to play in AI data centers for orchestration and inference. Foundry business. Intel is making steady progress in building its foundry business. They are now shipping products on Intel 18A, the most advanced semiconductor process developed and manufactured on U.S. soil. Engagement with external customers for Intel 14A is active, with key decisions expected in the latter half of 2026. Advanced packaging, particularly EMIB and EMIB-T, is seen as a strong differentiator with significant customer interest. ASICs. The custom ASIC business experienced strong growth, exceeding $1 billion in annualized revenue run rate, targeting a $100 billion TAM. Financial strengthening. Intel has strengthened its balance sheet through strategic partnerships, stake sales, Altera, Mobileye, and government funding. They repaid $3.7 billion of debt. Significant risk factors. Supply constraints. This remains a primary challenge, impacting their ability to meet demand across various product lines. While improving, yields are still below desired industry-leading standards. Component pricing. Rising prices for key components like DRAM and NAND are a concern, particularly for the client market, and could limit revenue opportunities. Execution. Management acknowledged that execution needs to continue to improve, especially in accelerating yield improvements and fab output. Foundry business ramp. Building a successful foundry business is a multi-year journey requiring significant investment and customer commitment. Lowlights. Supply shortages. The inability to fully meet market demand due to supply constraints was explicitly called out as a disappointment by the CEO. Gross margin pressure. The Q1 2026 gross margin forecast of 34.5% is considered by management to be not acceptable, due to lower revenue, increased 18A volumes, and product mix. Most important statements from management. CEO Lip-Bhutan. 2025 was a year of solid progress. Over the last 10 months, we established the foundation for new Intel, a more focused and execution-driven company. The era of artificial intelligence is driving unprecedented demand for semiconductors across the entire compute landscape. The breadth of our IP and know-how across silicon design, system-level integration, wafer manufacturing, and advanced packaging uniquely positions us to capitalize on these AI-driven trends and capture sustainable, profitable growth. Our Q4 was another positive step forward. Revenue, gross margin, and EPS were all above our guidance. We delivered these results despite supply constraints, which meaningfully limited our ability to capture all of the strengths in our underwriting markets. In closing, as I reflect on 2025, I'm proud of the resilient commitment our team has demonstrated. We exit the year with a stronger foundation and clearer roadmap for 2026 and beyond. I'm disappointed that we are not able to fully meet the demand in our markets. My team and I are working tirelessly to drive efficiency and more output from our fabs. While yields are in line with our internal plans, they are still below what I want them to be. CFO David Zinsner. Fourth quarter revenue was $13.7 billion at the high end of the range we provided in October. We experienced strong growth across all our businesses, benefiting from the AI infrastructure build-out with AI. PC, traditional server and networking revenue, all up double digits sequentially and year-over-year. Q4 marks the fifth consecutive quarter of revenue above our guidance, even as we navigate industry-wide supply constraints for our key products. Non-GAAP gross margin came in at 37.9%, approximately 140 basis points ahead of guidance on higher revenue and lower inventory reserves. As we enter 2026, our buffer inventory is depleted, and the mix shift in wafers towards servers will not come out of the fab until late Q1 26. As a result, our internal supply constraints are most acute in Q1. For the full year 2026, we expect our factory network to improve available supply beginning in Q2 and for each of the remaining quarters in 2026. Gross margin is down sequentially due to lower revenue, increased 18A volumes, and product mix. Let me take a few moments to provide some color for your full year 2026 model. First, from a revenue perspective, we expect our factory network to improve available supply beginning in Q2 and for each of the remaining quarters in 2026. In summary, Intel delivered a strong finish to 2025, exceeding guidance on key metrics, and is strategically positioned to capitalize on the AI revolution. While supply constraints remain a significant challenge, The company is focused on improving execution, strengthening its product roadmap, and rebuilding its foundry business for long-term profitable growth. They are cautiously optimistic about the year ahead, acknowledging the work still to be done.